Hi, Tal.
Hello. Hello.
Thank you for joining us. Excited to talk to you. Nasdaq has a bunch of different businesses, which give you, I think, a bunch of different lenses into how global business is thinking about the world, engaging. You obviously have the traditional listings business, which has historically a tech bent, so driving a huge portion of the stock market, if not the economy. And then you are yourself a tech company, and you sell software into financial services companies all over the world. So I think a great place to start is obviously not here at all, but back in Washington. Big story of the week. Donald Trump is president again. Let's assume that
I heard that.
Yeah. Let's assume that he's serious about everything that he says, that he's serious about the tariffs, that he's serious about the taxes, immigration, energy production, sustainability. What does that mix look like for global markets in particular?
So it's great to be here. Thanks for having me. I'm going to frame it as risk and opportunities. And the risks that we see is we're going to live in a more complex world where there's going to be more systemic risks that we deal with. So if you were thinking this was like a two-dimensional world, it's more like a four-dimensional world that we live in because of the complexity that this administration potentially introduces. The other is just it's going to reframe global trade. You talked about the Panama Canal. That's reframing global trade. He's also talking about bilateral agreements versus multilateral agreements, and I think that's just going to lead to more fragmentation in the way that the world deals with each other. And then finally, with respect to tariffs, he's got a pro-growth agenda, and we're curious to see how tariffs play into that. Does that lead into inflation? And remember, we're carrying a lot of debt. A lot of economies are carrying a lot of debt. A lot of governments are carrying a lot of debt. So we'll see how that plays out. So that's on one side of the ledger. On the other side of the ledger, to be fair, there's new partnerships that can be formed. He's given us a roadmap, if you will, of the new partnerships that could be formed, one. Two is there's going to be new investment opportunities. You talked about AI. We're going through an energy transition. He talked about some things on the energy side, but there's an AI revolution happening as well. So it's going to be really interesting to see how investment flows in and out of the U.S. and to other countries. And maybe the third opportunity for all of us is just, it's a forcing function. He's taking action, so it's going to make everybody else, every other region, so if you think about Europe or Asia, I'm sure they're already thinking, well, what actions do we want to take? So CMU and in Europe, like,
it's the Capital Markets Union.
Yeah, Capital Markets Union
get that
in
together
Europe.
for a long
Thank
time.
you. So maybe they want to think about that and take some action on that. So I think on the other side of the ledger, new partnerships, new investment opportunities, a forcing function will be very, very interesting how the balance of that plays out. And he's got 2 years, slim majority, but he's got 2 years to affect a lot of change. So we'll see what happens.
Yeah. You were talking about capital markets, and one thing that I think is interesting right now is that a lot of the growth industries, AI in particular, but to the extent we see a boom in energy, are very different than the last 10 years. They're very capital-intensive businesses, actually. And when you think about where the money is going to come from to build these data centers, to build these new drilling facilities, obviously you are in the capital markets business. Talk to me about where the capital is these days, where people want to put it, and the pipes through which it's going to travel, which have been changing pretty dramatically over the last decade or so.
Yeah, and you're specifically talking about AI and what you need to embrace it. Yeah. So it's interesting. I just had a conversation with somebody else, and we were talking about AI, and the conclusion that we came to, and that he suggested, and I thought it was really good, is a lot of the hyperscalers have built a lot of their infrastructure on common good. The internet was there, data centers were there, but now we have the AI revolution, and now they have to go and source energy and build their own data centers. And they have to do it in a carbon neutral, carbon friendly way. And the suggestion is if you have these hyperscalers building data centers and sourcing power, they may actually do it more efficiently than the government or than some of the private institutions beforehand. Because these institutions are very well run, think about their businesses. Yes, they care about the environment, but they also care about the bottom line, so they're going to do it the right way. So it's going to be really interesting how the hyperscalers invest in energy, because energy and AI play together, and one needs the other. But for companies like us and others, what role do we play? How do we think about our role as a financial technology provider? Twofold with it when it comes to AI, and maybe this is one of the investments we're making, just to highlight. We're investing in our people. You cannot take this journey alone. You cannot take this journey as a company without taking your employee base with you. That means upskilling them, reskilling them, making sure they're comfortable with this technology. They're the ones that are going to be invoking the power of that technology. So that's one major investment we're making. The other is in educating and empowering our clients, and really going on that journey with our clients and saying, this is the transformation you're about to go on. This is the investments you need to make. You need to manage your data better. You need to embrace the cloud. You need to have strong governance over information security. You need to have a mature posture on information security. Do you have all these? These are the investments you need to make if you say you're going to take advantage of AI. So we walk them through that, we provide them a blueprint, and then we hold their hand, because we, as you said, are a highly regulated institution ourselves, and we need to do it. So that's the advantage that Nasdaq has, is we're selling technology that we use, and then we can provide a blueprint on how to use it if you're a customer of ours.
There's a lot of anxiety, I think, in the labor market about, is my job going to be replaced by AI? And what I hear from CEOs is, well, we have the same number of people and they're going to be more productive. But obviously the flip side of that down the road is that you can do the same thing you're doing now with fewer people. So can you talk a little bit about kind of the places where you actually see it truly replacing some jobs, and then the places where you see it kind of adding to productivity and creating new jobs too?
The attitude we've taken with AI is we want it to be people-led. And that's an important distinction when we talk about AI. And we frame AI in two ways: in the product and on the business. When we talk about in the product, we're talking about three things that we would like to generate for our customers: intelligent workflow orchestration, right? Automation, productivity, helping them manage risk, and maybe even achieve alpha. That's what we're looking to do in the product. And from a jobs perspective, from our perspective, we're elevating the jobs of the individuals that we have currently to focus more on decision-making tasks and what's really important, what's driving value, versus some of the other things we were doing. So it's not necessarily about the employee base that we have now per se, but our ability to grow without having to hire at the same rate that we would have. So there's a productivity gain, because we're a growth company, so we're growing 8 to 10% a year. It used to be that you need to hire to grow. And
For
now
the
you
audience,
can think
about how many employees does Nasdaq have?
What's that?
About how many employees?
We have 8,800, almost 9,000. 9,000, and it's globally distributed. And so we have a large workforce, and most of that workforce, half that workforce, is in technology, in engineering, QA, on that side of the house. And so we very much see it as a growth company. There's an opportunity to upskill, have them focus on higher decision-making tasks, and the ability to grow, maybe with some productivity gains baked into it, so you get operating leverage. It's really the operating leverage that it provides us in the business.
You mentioned sustainability earlier, and I've been coming to Davos for probably a few too many years, and for a long time, particularly in late 2010s, early 2020s, this was a real ESG place. There was a lot of talk about stakeholder capitalism and diversity. We're only on day 2 here, but feels like a lot less of that to me this year. And I'm sort of curious sort of how you think about that, your capital markets business. This is a bit of a corporate, it shapes corporate behavior through its listing gating function. And really has a line into how ultimately asset owners, who are a big push toward the progressive side of things a few years ago, how they're thinking about it. How has that changed?
So it's interesting. I'll tell you the role that we play and how that role changed, and we play a number of different roles. As a stock exchange that has listed companies, we're trying to make sure that we have constructive dialogue between issuers and investors on sustainability and governance and ESG more broadly. That's very important. That was not a healthy dialogue at one point, and it's getting better. And we're helping issuers and corporates understand the kinds of disclosure they need to make, the kinds of transparency that's required. So that's still ongoing. And that dialogue, that nexus between corporate and investors, there's a real role for us to play there. That's first. On the other side of it, we're playing a role in carbon markets. We actually still believe in carbon markets and that being an asset class, and us wanting to mature that and advance that. So we are supplying technology to carbon markets. We launched our own carbon registry and platform by the name of Puro. So carbon, if you just break that out for a second, we still believe in that. We think there's going to be a push. And irrespective of what was said last night, we think there's still going to be demand, and it's going to be hard to stop the momentum there. But more broadly, I think if you're an asset manager, an asset owner, I think the conversation is probably shifting to what it was before, which is, how do I generate the best returns? And so how do I generate the best returns while being responsible? And maybe the weighting of that has shifted.
Yeah. A lot of the growth in capital markets over the past decade has been on the private side. These are not public stock exchange, public bonds, but this is private capital. Is that shift permanent? Is there a pendulum that's going to swing back to the public markets? And where are you guys playing, given how quickly that's grown?
Let's frame the public and private markets discussion. So the private markets has about 15 trillion in AUM. The public markets has about 112 trillion in market cap. A little different, right? And so I think there could be a partnership still. That's my belief, which is to say, if you have a healthy private market ecosystem, capital there for growth capital, for young companies, to seed innovation, very important. And I think in the US we've done a good job of that, of seeding innovation, seeding new entrepreneurs, seeding companies that otherwise couldn't get to the capital markets or couldn't access capital through banks. So private equity's played an incredibly important role and a really good role. And a lot of the companies that we welcome into the public markets come from the private equity side of the house. And then there's well, why are you public? And there's two things to that we need to talk about. One is there's still a massive liquidity event when you go public. Like I said, that's why I highlighted 113 trillion to 15 trillion. If you're a massive company and you're looking for liquidity, it's just apples and oranges in terms of the kind of liquidity you can still find in the public markets versus the private. But the private markets serve a real need. But the private markets, for small and mid-sized companies, if you're below $1 billion in the US, you might ask yourself, with all this regulation, Sarbanes-Oxley, the reporting requirements, proxies, all of that, is it worth the cost? Is it worth the cost? Maybe that's what you're getting after. And so we are advocating and will advocate with the new administration to say, hey, listen, for small and medium-sized companies in the US and probably globally, you should think about 3 or 4 things on the corporate side. One is proxy reform. The second one, corporate disclosure. Maybe a more flexible, not a one-size-fits-all approach. And then tort reform. You know, can anybody just launch a lawsuit on a public company and you're the CFO and you're like, what happened? What is this about? And then proxy, same thing. There could be the same thing that appears again and again and again and again, and you have to spend money and fight it again and again and again and again. So there are certain things that are built-in costs that we think for the SME sector, the small and medium-sized enterprise sector, that we would like this administration to consider. Now, President Trump has said he wants to remove red tape, he wants to deregulate, he wants smart regulation, and so I think that plays into this administration's agenda. I think he wants to see a healthy capital markets, and that's part of what we think is a healthy capital markets, welcoming these smaller and mid-sized companies without the burden that maybe, you know, should they have the same burden as a $3.5 trillion company?
How do you communicate that to the incoming administration? I mean, there's a way that this used to happen, which is through lobbyists and a pretty understandable It seems to me like it's happening in a very different way right now.
So we're still figuring out who's in the administration, who's at the SEC, who's at the CFTC, which he's just announced, and they're being sworn in and brought in. And so once everybody's in their seat, we'll probably give them a good 24 hours before we call them and have discussions with them about our agenda. And we want to be on the front foot. It's really important what you said. With this administration, you need to make sure that your voice is heard, because there could be unintended consequences. It could just be that the last voice in the room was the most impactful, and therefore there's change based on that most impactful voice. So you need to get in front of this administration. Don't think the other way around. Don't think, I don't want to be part of it. I don't want to be in those meetings. I don't want to talk to them. You should be thinking, I need to be in the room. I need to be part of the discussion, so I'm not an unintended consequence as a result of that.
Going back to something you just said about reform for smaller companies, we tried that. The Jobs Act was supposed to do exactly that, and actually the biggest beneficiaries ended up being these like big Silicon Valley unicorns. Although you're saying that there's some unintended consequences of regulation, and I wonder whether the companies that you're talking about, for which the public markets may not be the best fit, it actually seems that it's the giant, like, big consumer names that the private markets actually want to fund. So where does the money come from? What's the nice thing about exchanges? They get all the money in a room, and then they give it to issuers for shares. What is the forum for which that's going to happen on the private side, particularly for smaller companies that just don't have the name recognition, don't have investors knocking down their door?
It's a great point. And so the private market needs to mature and advance in order to really bring price formation, price discovery, and liquidity in a cost-effective manner that's not episodic. So we're not talking about just an episodic, you're talking about continuous. And so episodic, it's there, but continuous, more transparency. So there needs to be more transparency, needs to be more trust, more infrastructure built out in the system so that price discovery, price formation can work more effectively in the private markets if you want this to occur. Now, for episodic liquidity, it works pretty well.
You were talking about Europe a little bit earlier, and the biggest financial services companies in Europe these days are American. Biggest banks are American. I think the top 10 asset managers are basically split between imports and homegrown. And I should note that your listing business and NYSE's listing business has taken a lot of listings particularly from London. Curious sort of where you see European competitiveness going, like how they actually start to grow again.
So we operate markets in Europe, in the Nordics, in the Baltics, and Iceland, for those that did not know. And so we operate 18 markets across the globe, and we're really proud of that fact. And we've met with the officials in Brussels, we met with ESMA, and we've said to them, we want to be part of the solution. And we said, if you want to really put forth a solution under CMU, as we talked about before, we said there's probably 4 things that you need to look at. One is the legal framework. It's inconsistent across Europe. And by the way, the UK is not even part of Europe. So let's just talk about Europe and then UK and figure out how the legal system works. Think about bankruptcy law, for example. The second is there's a lot of regulatory friction across Europe. Not easy to do business. It's expensive. The post-trade part of Europe is also expensive. Not the fungibility you would expect. It doesn't have the interoperability you expect. That's the second. Then we said taxation is third. Taxation, you could be more constructive in your tax regime. And fourth is cultural and very structural. There's not a lot of equity-loving culture across Europe. It's more debt-loving in some ways. And so how do you have the younger generation really get enthusiastic about investing in tech companies, in small and medium companies? And we gave them 2 examples. We gave them, in the Nordics, we do that quite well. We have retail and the pension funds really supporting small and medium-sized company IPOs. We said, look at that. And they said, well, how is that? And we said, look at the tax regime, look at the regulatory regime. It's really constructive, something for you to look at. And they are. And then the last thing is, we said consolidation. There needs to be some level of consolidation across Europe. It's just not big enough. It has no scale. The word scale is a difficult thing to come by in Europe. So we said, if you really want scale, you're going to have to harmonize and consolidate some of your post-trade infrastructure, and you're going to have to look at it on the trading side too. Maybe regional, not across all of Europe. And we did that in the Baltics. We have one CSD for the entire Baltics. And the only way we could survive and the market could thrive is if we did that. So we gave them that example. One rule book, one piece of technology, a single technology stack supporting all of the Baltics. And we said, use those as examples. There's other examples. I think Japan has done some really good things with the NISA program, the savings program. So they've been really innovative there, and it's got money back into the market. So there's examples there. We want to be part of the solution. I would say that if you heard the inauguration speech last night and you're sitting there in Europe, either you need to catalyze action, or you may be thinking to yourself, well, hold on, this could mean more listings come to the U.S. based on what he just said, right? So hopefully it catalyzes action and we see growth on both sides of the pond.
Yeah. You were talking about carbon earlier. You believe in that as an asset class. We have to talk about crypto. How would it make sense for Nasdaq to play in that, for it to come sort of off the fringes of finance and into, I think Coinbase is right upstairs. They built a giant business on the idea that the traditional exchanges didn't really want to get in this business or couldn't get their arms around it. We obviously have a very crypto-friendly administration coming in. What do you think?
Regulatory clarity. And so there was a debate 2-3 years ago, 5 years ago, about what's a security, what's not a security. Is Ethereum a security? Is it not a security? And then, by the way, who regulates it? Is it the SEC or the CFTC? Are they talking to one another? Oh, and by the way, do we need legislative action to understand exactly how you want us to go about then the custody, the trading, and the consumer side of it? And it was a retail phenomenon. So that's the other piece of it too. For Nasdaq, that's not our forte. We're more B2B.
You're waiting for the institutions to pick it up.
We service institutions. We service the biggest banks and brokers in the world. The retail side of it is a different animal, to be fair. And so we thought long and hard about the customer side of that. 1. 2, regulatory clarity. And 3 is we looked at it and the infrastructure wasn't there for us. We would have to build the infrastructure, and there's a lot of vertical silos that are still present in crypto. Vertical silos where you're the broker, the exchange, and the custodian, and the clearinghouse. And in our world, that's a conflict of interest. And so we looked at DTCC and we looked at other institutions and said, if the infrastructure is there, and there's regulatory clarity, and there's institutional engagement and adoption, we absolutely want to be there. That's one thing on the exchange side of it. On the other side of it, we've been selling technology for the last 7, 8 years into crypto. We're probably the largest provider of tech into crypto, trading engines, surveillance. We do other things that provide and enable crypto and provide institutional grade technology, very importantly, into crypto. So we're really proud of our presence in crypto. We've supported it. We've been a public advocate of innovation, just making sure that it's balanced against investor protection. That's always been our stance. Just balance investor protection with innovation and allow this technology to mature and advance. But what was happening in silos. And hopefully the new administration will bring it back into, we call it like TradFi and DeFi. Just let's bring it into the banking system. Let's try that.
Just FI. Just going to FI it.
Just FI.
Well, thank you so much. This is, a really interesting conversation. I'm sure everyone can agree. And we'll have you back next year to see how it's played out.
Thank you. Really appreciate it.